Here to dive into industry trends with leading ETF experts, this is ETF Spotlight with Nina Mishra.
Hello and welcome to ETF Spotlight. I'm your host, Nina Mishra. My guest today is Graham Day, Chief Investment Officer at Innovator Capital Management. And Innovator, as we know, is a pioneer and provider of the first and the largest lineup of defined outcome or buffer ETFs. And yesterday, they launched the first ETF that provides exposure to Bitcoin's upside potential while capping downside losses. It is called the Innovator Uncapped Bitcoin 20 Floor ETF. Ticker symbol, there's quarterly too. The ticker symbol is QBF. Graham, welcome. Great to have you with us today.
Nina, it's great to be here. Thank you so much for inviting me on.
So let's talk about QBF. Could you explain what it aims to do and also what investors give up in return for that downside protection?
Yeah, absolutely. And so one of the things, as you pointed out, Nina, is we've pioneered this defined outcome ETF space. And really the idea is that we want to provide exposure to asset classes in a risk managed way that provides as much of the benefits of that asset class while mitigating various levels of downside risk. And when we were looking at the Bitcoin space, one of the things that we've continued to see is that more and more advisors are being asked by their clients, what are we doing about this Bitcoin? Are we going to allocate? Are we going to just stay on the sidelines? And what we found is that the two biggest concerns that advisors have had with regards to investing in Bitcoin have been regulatory and volatility concerns. Volatility is too high, just uncertainty around the asset class has weighed on them. And that tells us that they are willing to potentially give up all of their upside in exchange for having known levels of downside protection. And so what we did with QBF was we looked historically at the returns of Bitcoin. And what we found was over 3-month timeframes, Bitcoin, like it does over longer periods of time, it has big moves up or down. And what we realized was that if we could develop a strategy that gave investors uncapped exposure to the right tail of Bitcoin, as we know, it's not like the S&P. A big quarter in the S&P, 7 or 8%. A big quarter in Bitcoin, 150%. Very different exposure. That if we could give uncapped exposure to the right tail and then cap the worst losses of Bitcoin, we could have a strategy that allowed advisors to get clients invested in Bitcoin, reduce the fear of losing everything, reduce volatility, but most importantly, maintain that right tail exposure, the asymmetric return profile that so many advisors, investors have come to embrace with Bitcoin. And so at a high level, QBF is very simple. Every quarter, we're going to provide uncapped exposure to Bitcoin, spot Bitcoin. Now, we have a 20% max loss every 3 months. So that means if Bitcoin is down 50, 60% in a quarter, which it drops that much, second quarter of 2022, it was down 60% in one quarter. Your max loss is 20%. Now that protection is not free, but what we've done differently than what we've maybe provided in the past is instead of a hard cap on the upside, what we're providing is a participation rate. And the current participation rate is 80%, which means that over the remainder of the outcome period, if any of the price appreciation that Bitcoin attains, this ETF will give you 80% of that. So if Bitcoin is up 50%, you would be up 40%. If Bitcoin goes up 80% or 100%, you would be up 80% in that time frame. And so again, this strategy is looking to capitalize on the fact that Bitcoin has big positive moves in 3 months. The average Bitcoin quarterly return, 61%. On the left-hand side, we found that almost half of losses exceed 20% in one quarter. The average of those losses is north of 40%. And so we're trying to give the best of the right tail and mitigate the worst of the left tail for Bitcoin investors.
Very interesting. So 80% of upside and 20% of max loss. Sounds very interesting. So tell us how exactly the product works, what it holds. How does the product achieve these objectives?
Very simple. Just like our other defined outcome ETFs, it may sound complicated because we're utilizing options, but effectively what we're doing is we're utilizing 2 layers to construct this ETF. The first layer is a simple portfolio of options that gives you the upside exposure at an 80% level to the price appreciation of Bitcoin, as well as that 20% one-to-one on the downside. And then we hold a basket of treasuries. And we have 80% every quarter is in treasuries, 20% is in the options portfolio. In this case, the treasuries are what serve as the cushion on the downside. We have 80%. That's why we say our max loss is 20% over a 3-month outcome period. And we're using treasuries for diversification purposes to meet RIC diversification requirements. But at the end of the 3 months, what happens, just like our other defined outcome ETFs, we're going to reset the downside protection. Again, have a max loss of 20% for the next quarter. What will change outcome period to outcome period is going to be that upside participation rate. Again, right now it's at 80%. We've seen it range historically, typically in the 65 to 85% range. That's going to be the variable that changes from outcome period to outcome period.
So the outcome period for this particular ETF I see is from February 6th because you launched it yesterday and till 31st March 2025. So is that correct?
That's right.
And so what kind of outcome can investors who buy the product after the launch, what kind of outcome they can expect? And you mentioned that the ETF is going to reset every quarter and participation rate may change. So what will impact that participation rate and the downside protection level, the interest rates at that point of time?
Yes, volatility and interest rates will be the main drivers of that participation rate. Now, for investors that maybe they didn't buy the first day of the outcome period, just like all of our other defined outcome ETFs, we want to emphasize that those that buy at any point during the outcome period. So if you buy March 1st, maybe you just learn about this product on March 1st and you look and there's 31 days left in the outcome period, you still have the ability to achieve a defined outcome because the options portfolio, the treasury portfolio, they're fixed for the entirety of this outcome period. And if you come to our website, you'll see there's a tool that will allow you to see if I buy today. So let's again just fast forward to March 1st, and it'll tell you if Bitcoin, say it goes down 30%, here's exactly what this ETF will do. If it goes up 30% or 50% over the remainder of the outcome period, here's exactly what the ETF will do. And again, I think that level of certainty is really important for advisors in communicating to their clients to manage expectations, especially around an asset class that can be as volatile as Bitcoin.
Right. So we have seen a flurry of these filings and also launches of some of these structured protection Bitcoin ETFs. Calamos has launched 3 ETFs, and I saw that First Risk and Grayscale, they are also planning to launch similar products. So could you explain why now? Because Bitcoin ETFs, spot Bitcoin ETFs, they launched about a year back and they were immensely popular. They have been immensely popular. They have seen record inflows. IBIT by iShares, that became the most successful ETF launch ever. But options on these option contracts on these ETFs, they started trading in November. So could you explain how the listing of option contracts facilitated the launch of these structured products?
Absolutely. And as you can imagine, when the spot Bitcoin ETFs were launched, there was actually an expectation that the options would be available on those spot Bitcoin ETFs in short order. But due to a number of regulatory hurdles that I think many in the industry were unaware of, it took time for options to become available on those ETFs, and ultimately taking 10, 11 months to finally achieve. But even with the listing of options on the single Bitcoin ETFs, there remained some position limit requirements or rules that limited how much another fund or you can own of outstanding options contracts on those ETFs. And so we had been working alongside CBOE, the CBOE, in constructing an index that would track spot Bitcoin. And they launched that as well as options on that index. And the position limit sizes were significantly higher than those on spot Bitcoin ETFs. And that's what really paved a path, a way for us to bring strategies on spot Bitcoin that use options to provide these defined payoffs. And Nina, as you mentioned, there's many others that have looked in this space. And what distinguishes QBF relative to the competitors is really two things. The first is the uncapped nature of this product. When you look at capping Bitcoin historically, and we're talking even as recently as 2024, when Bitcoin was up over 100%, or 2023 when it was down up 160%. When you put a cap on Bitcoin's upside, you significantly alter the resulting payoff profile so that it really becomes something different than Bitcoin. You're not really getting a Bitcoin-like experience, which is fine. There are some people that say that that's great. I'm looking to add an alternative asset in my portfolio. What we're trying to do with QBF is to give advisors the ability to invest more confidently in Bitcoin, knowing they can participate in as much right tail upside as Bitcoin delivers, but also limiting that fear of loss that might have been holding them back from investing their clients in Bitcoin, or perhaps they have some exposure to Bitcoin. This is a way to add a little bit more without introducing all of the downside risk of Bitcoin. And I think there's just a couple of really important facts and figures to look at. If we look at 2018, Bitcoin was down 74% in 1 year. But really, it came down to 2 quarters where it experienced all the downside loss. The first quarter, it was down 51%. The fourth quarter, it was down 44%. And in 2019, Bitcoin was up 95%. All of that gain came in 1 quarter. The second quarter of 2019, when it was up 178%. And so you hear me talking about these quarterly returns because That's why we chose to have QBF provide quarterly outcome periods to limit these extreme losses that you can experience over short periods of time. But most importantly, to give you that uncapped exposure to these big quarterly returns, like that 178% return in Q2 of 2019 without capping it. And then the second feature is that quarterly reset, which if it's up, you're going to lock in that gain and you're going to reset your floor at a higher cost basis. And it does it for you. It's a single ticker solution. So you don't have to evaluate lots of different strategies. It's an easy way to add Bitcoin in a risk managed format that maintains the right tail upside potential of Bitcoin.
Right. So I agree that uncapped potential makes this product really attractive to many investors. But you mentioned Bitcoin's volatility a number of times. And that is why I wanted to talk a little bit about some of the criticism that I've heard about these products. Some say that Bitcoin is suitable only for investors who fully understand the risk. So because risk-averse and Bitcoin, they seem like a contradiction. And the whole point of getting exposure to Bitcoin is to embrace its volatility, because if you don't embrace volatility, you wouldn't have the potential for those outsized returns. So could you talk a little bit about that?
Yeah, absolutely. And I think those comments are 100% correct, and we would fully agree with it. And if you take a blanket approach to trying to mitigate Bitcoin's volatility, if you're just saying, hey, you know what, Bitcoin's too volatile, I don't like the standard deviation of it, and you try to dampen it broadly, then what you're doing is you're significantly impairing your ability to get anything like Bitcoin. And I think that goes back to the earlier comments about if you cap your upside over time, you're not going to have a return profile that looks or feels anything like Bitcoin, which is fine. Some people like that. Some people aren't looking for a Bitcoin-like experience. Maybe they're just trying to add an alternative type payoff into their portfolio. But when we look at the historical volatility of Bitcoin, it's a really interesting study because the upside volatility of Bitcoin is actually higher than the downside volatility. So if I go back to the comment I made about reducing or putting taking a blanket approach to reducing Bitcoin volatility, you're ultimately hurting your upside significantly more than you're helping on the downside. That's why we took this approach of we're simply going to try to mitigate the worst downside volatility, capping the losses at 20% a quarter. We know that most Bitcoin investors, or even those that are looking at this asset class, know they have to take a level of risk. They just don't want to put all of their, take 100% downside risk every 3 months. But most importantly, they want the ability to participate in that right tail of Bitcoin, which, as I just mentioned, the upside volatility of Bitcoin is higher than the downside volatility. You want volatility with Bitcoin. You want to embrace as much of that right tail volatility as you possibly can. This is the strategy that really we think accomplishes that in a defined outcome manner. You can still know exactly what your upside and potential downside returns are at any point during the outcome period.
So let's talk about the advantage of the ETF wrapper for this strategy, because you explained that the ETF uses option contracts. So can investors themselves use derivatives to create a similar strategy with the similar outcome and tax efficiency?
Well, they could certainly access the options themselves and try to reconstruct this payoff profile. But one thing we continue to have conversations with advisors, RIAs, institutions about trying to construct these these payout profiles on their own. The first is we've grown to a level now where we have extremely competitive pricing on the options. We have groups that are competing for our options orders on all of our S&P and NASDAQ and Russell buffer ETFs on a daily basis. We have a very liquid, competitive ecosystem to ensure we have the best options pricing possible. I would say that holds especially true with this more novel area of the options market, that if you're trying to get quotes, if you're trading these options on screen, it's going to be hard to match the level of pricing that we're able to get. I would also point out for taxable investors, we are hopeful that these ETFs will be as tax efficient as our existing buffer ETFs. And that's because of the in-kind creation redemption process unique to ETFs. And so if you're trying to construct these types of payoffs within outside of the ETF wrapper, you're going to be incurring taxable events as you roll the options, as you trade in and out of the options. And so we found many RIAs have tried to price these out themselves and have had significantly lower upside participation or lower upside caps. And they realize that's on a pre-tax basis. So they continue to see the benefit of utilizing the ETF wrapper. I would also point out, Nina, as we're having conversations with groups that use Bitcoin, advisors, RIAs that have been trading Bitcoin maybe for 5-10 years, they like this approach because they don't have to figure out the crypto wallet. How do you scale that across all of your client accounts? You don't have to worry about the safety of owning Bitcoin directly. We take care of that through the ETF wrapper. You can implement this strategy across all of your client accounts, one trade operationally. It makes things a lot easier for the advisor. They don't have to worry about a lot of the back office work that would be involved doing it themselves, or even using spot Bitcoin directly as well.
Excellent. That's why we all love the ETF wrapper. So I wanted to talk a little bit about the defined outcome and buffer ETFs in general, because we have seen a surge in popularity of these products. And as we mentioned earlier, Innovator pioneered these products, and you launched the first such ETF in 2018. And since then, assets have been just surging. So could you talk a little bit about what's behind the surge in popularity of these strategies? Who is buying these products?
Well, what we found is the vast majority of our client base, and I think probably speak on behalf of the industry, RIAs are the number one client base for these types of exposures. Now, one of the things that we'll say at Innovator is we are not the inventors of a defined outcome payoff. We did invent the first defined outcome ETF. And so what we did was take payoffs that were previously only available in structured notes, annuities, and make them available in the ETF wrapper for the first time. And I think what we realized is we had entered this massive market. If we look at just annuity sales each year, I think they record 400 billion maybe, or 500 billion in annuity sales last year. Structured notes, 150 plus $1 billion in sales last year. Those are sales figures. We look at the ETF, the defined outcome ETF space, and I think we're probably around 50 to $60 billion in AUM. So that's an AUM figure versus what we're seeing done every single year in the insurance space, in the structured note space. We know that there's significant demand for these types of payoffs. They just didn't have it available in the ETF wrapper. Speaking specifically to advisors, how are they using these? Well, there's a number of ways, and we've been amazed at how advisors have used these ETFs to address client needs. Probably the first is sometimes clients are nearing retirement and they don't necessarily have the ability to take on full equity risk. This has been a great way to use our ETFs to get equity-like exposure, but manage some of the downside risk in a defined manner. One of the more popular ways over the last 3 or 4 years have been as a bond replacement. When interest rates went to zero, people said, well, why are we owning bonds? There's no upside benefit left. There's only downside risk. They can't just move that bond, that safe money, into unhedged equities. They used buffers. And then finally, cash on the sidelines continues to be at record high levels. How do you get a client that is in cash because they want certainty? How do you get them into the market? You can't say, just trust us. Over time, the market goes up, because as soon as the market goes down, they're going to say, why did you put me in the stock market? It's a tool to get clients off the sidelines, get them more comfortable, but provide that definition that they love about cash as well.
Excellent points. We'll have to leave it there, Graham. Thank you so much for joining us today. And also congratulations on the launch and on the immense success of your buffer strategies.
Well, thank you so much, Nina.
That was Graham Day of Innovator. Let's quickly recap the ETF tickers that we mentioned. So Innovator's product is QBF. And as we discussed, this is the first ETF which offers uncapped exposure with a participation rate of 80%. And as I mentioned earlier, Calamos has launched 3 protected Bitcoin ETFs. The ticker symbols are CBOJ, CBXJ, and CBTJ. So these 3, they have different upside caps and different protection levels. So check out Calamos website if you want to learn more about those products. And we mentioned IBIT, the iShares Bitcoin ETF. That is the most popular spot Bitcoin ETF and also the most successful ETF launch ever. Thanks for listening. If you like our show, please leave us a rating on iTunes or wherever you get your podcast. Make sure to subscribe so that you do not miss any episode. If you have any comments, questions, or suggestions, please email podcast@zacks.com.
This material is being provided for informational purposes only, and nothing herein constitutes investment, legal, accounting, or tax advice, or a recommendation to buy, sell, or hold a security. Do not act or rely upon the information and advice given in this podcast without seeking the services of competent and professional legal, tax, or accounting counsel. Publication and distribution of this podcast is not intended to create, and the information contained herein does not constitute an attorney-client relationship. No recommendation or advice is being given as to whether any investment or strategy is suitable for a particular investor. It should not be assumed that any investments in securities, companies, sectors, or markets identified and described were or will be profitable. All information is current as of the date herein and is subject to change without notice. Any views or opinions expressed may not reflect those of Zacks Investment Research as a whole.